Hello and good morning from Europe and good afternoon to Asia. Hi and welcome to this Green Bond webinar, which will give you a compact overview of the green bond market with a special focus on external reviews. My name is Louisa Linton and I support this partnership as a project manager at GIZ. Before we start, let me give you a brief introduction into the project. So we're waiting for the next slide, there it is. In this partnership, we have been working for over 2 years for the public benefit of supporting the development of robust and sustainable green bond markets in emerging economies. Our approach is to raise awareness and build competence among the different market actors through workshops, roundtables and conferences, through bilateral advisory support, as well as through knowledge products such as research, publications, or this webinar indeed. Our main partner is SEB, which has co-developed the green bond concept for institutional investors and supported the first green bond issuance by the World Bank in 2008. As structural advisor and one of the leading underwriters, the Swedish bank led a number of path-breaking green bond issuances, including the first money green bond, the first non-supranational green bond, and the first corporate green bond. Moreover, SEB is one of the founding banks of the Green Bond Principles that you will learn about later. It's a member of its executive committee and leads the working group on external reviews. And we also partner with Cicero, one of the leading institutes for interdisciplinary climate research, which has been actively involved in the IPCC since the 1990s. The independent Norwegian Institute was the first to provide a second opinion for green bonds. You will also learn about those, and remains until today the largest provider of such, being recognized in the market for its science-based approach, deep expertise, and high integrity. And lastly, the project is being facilitated and managed by GIZ. GIZ is a German public benefit federal enterprise that works jointly with governments, international organizations, businesses, civil society actors, and research institutions worldwide to foster international cooperation for sustainable development. Through the developPPP.de program, we work on behalf of the German Federal Ministry for Economic Cooperation and Development with the private sector to support innovative projects in developing and emerging economies for sustainable development. So back to the green bonds. During the next 45 minutes, you will get an introduction to green bonds by our experts from Cicero and SEB. You will gain an understanding of why green bonds matter, how the market developed, and why issuers and investors have become so keen on getting involved in the market. This part will be covered by Ben Powell, senior banker at SEB, who would also explain the green bond principles, how a green bond framework is set up, and how the issuance process is structured. After that, we'll look deeper into external reviews and impact reporting, two essential aspects of safeguarding the integrity in green bond markets. This part today will be led by Harald Franke-Lund, senior advisor at Cicero, who will also kick off now with a brief look into climate science. In the end, we will also have some time for questions, which we kindly ask you to submit via the chat function in GoToWebinar. So without further ado, I hand over to Harald.
Thank you very much. In this section, I will give a brief overview of climate science, the motivation for green bonds. We are already experiencing climate change. This graphic shows the annual global temperatures from 1850 to last year and is a visual representation of the approximately 1 degree of warming that has already occurred. Last year, the IPCC launched a report on 1.5 degrees. This special report is a follow-up on the Paris Agreement, which sets a goal to keep global warming well below 2 degrees above pre-industrial levels and to pursue the efforts to limit the temperature increase to 1.5 degrees above pre-industrial levels, recognizing that this will significantly reduce the risk and impacts of climate change. The IPCC report concludes that 2 degrees of global warming will lead to more heat-related deaths, smaller crop yields, worse extreme weather events, slower economic growth, more people in poverty, and increase the population facing water stress by to 50% compared to a 1.5 degree world. And the impacts will get progressively worse if temperatures warm beyond the 2 degree limit. The good news from this report is that we are not locked in to a 1.5 degree world yet. It is both physically and technologically feasible, but politically very demanding. Emission must go to zero within a few decades, or we need large-scale negative emissions. This is what science tells us to stay well below 2 degrees. We are used to think that we are safer if we don't rock the boat. Business as usual sounds like the least dangerous scenario. When it comes to climate change, it is the opposite. Business as usual means global warming at the end of this century at 4 degrees. That is a giant experiment, and we don't know the consequences. The take-home message is that the faster we cut carbon pollution, the less severe impacts we will face. Climate risks are financial risks. Regardless of the degrees of warming, climate risk is financial risk, and the leading financial institution understands this. These risks are typically grouped into physical risk and transition risks. Many physical impacts that scientists had originally anticipated over a longer time horizon are being observed today. For example, we are already experiencing the impacts of the interaction between sea level rise and the extreme weather events. Global losses from extreme weather events rose by 86% from 2007 to 2017. Investors should expect stronger hurricanes combined with flooding and sea level rise that leads to significant damage. Flooding, wet areas will become wetter, drought, and wildfires. There is also a transition risk that the financial sector needs to know and understand. This is connected to changes in policy, liability, or technology that can impact markets and consumer behavior. Policy risk is connected to for instance, CO2 taxes, regulations, subsidies, while liability could be countries or organizations that take legal actions against fossil fuel companies and countries for their role of causing climate change. In order to avoid dangerous climate change and reach the targets agreed upon in the Paris Agreement, we still need policymakers to substantially step up their efforts in strengthening climate policies. However, without the financial sector's correcting pricing of climate risk, there is no way we will succeed in the necessary transformation towards a low carbon and climate resilient future. The transition is not only about risk. On the flip side, it will also lead to investment opportunities for forward-thinking companies and investors. Green bonds are one example of these. Green solutions are scalable. We have already seen this. Huge investments needs in infrastructure represent green investments opportunities and potential for further growth in the green bond market. Technological developments in clean technology are changing the landscape. One example of this rapid development is in wind turbines, as seen here. Green solutions are scalable, and green bonds can be used to finance both low carbon and adaptation solutions. I now pass it over to Ben, who will walk you through the green bond basics and market development.
Thanks, Harald. Hello, everyone. So my name is Ben Powell. I'm part of the Climate and Sustainable Finance team at SEB. In this section, we'll be going into a little bit more detail as to what makes a bond green and what information the market expects from bond issuers. So first, a little bit of information as to what a bond is. So a bond is a debt instrument whereby a group of investors loans money to an institution, for example, a company or a government, and receives a fixed or variable interest rate in return. A bond is typically arranged and underwritten by a bank on behalf of the bond issuer. And that bond issuer, remember, is a company or a government that will receive the proceeds of the bond. The main difference between a bond and a bank loan is that a bond is traded in an open market and can be bought by the general public, often through institutional investors and asset managers. So what is it that makes a bond green? Well, green bonds are any type of bond instrument where the proceeds will be exclusively applied to finance or refinance new or existing eligible green projects, and which are aligned with the 4 core components of the green bond principles. This definition was agreed upon by a consortium of major banks, investors, and issuers, organized by the International Capital Market Association, or ICMA, and set the foundation for creating a set of voluntary guidelines named the Green Bond Principles in January 2014. This is one of the most widely accepted definitions on the market. In addition to this, many countries have adopted their own green bond guidelines and use the Green Bond Principles as the foundation for creating national guidelines. Green bonds share the same underlying mechanisms as regular bonds in terms of process between issuers and investors, pricing, tenor, and secondary market or secondary trading. The main difference is that only predefined projects leading to an environmental benefit can be financed. For example, a property development company can raise a regular bond to finance all types of properties and day-to-day operations. However, a green bond by the same company can only be issued or be used for predefined projects with an environmental benefit, such as for properties with 30% less energy use than the national average, or that meet certain green building certifications. The Green Bond Principles have been established to provide a methodology for green bond frameworks that ensure that green projects are defined and that the issuer sets up robust governance procedures to safeguard a sufficiently high environmental integrity, thereby making sure that it can deliver on its green promise and report progress to investors. Now we'll look at the 4 components that make up the Green Bond Principles. One of the Green Bond Principles is use of proceeds. This concerns definitions of eligible projects and are typically divided into the following 3 areas that target climate and environmental stress: mitigation, adaptation, and other environmental projects. The second principle is the process for project evaluation and selection. The third principle is management of proceeds. This concerns traceability and monitoring of the money raised through the bond issue. The fourth principle of the Green Bond Principles is reporting, and here transparency is the key. An issuer is expected to describe how it intends to abide by the Green Bond Principles in a document called the Green Bond Framework. As this document is made publicly available in connection with the green bond issuance, investors can learn about the issuer's intended use of proceeds and how the governance procedure is structured for selecting, monitoring, and reporting on investments. Consequently, the Green Bond Framework is central in the issuance of a green bond. In fact, it's considered one of the most important documents of a green bond issue in combination with an external review. As the Green Bond Principles encourage a high level of transparency, it's recommended that an issuer's green bond framework and its internal environmental governance procedures are evaluated by an external reviewer, which provides evaluation through an independent external assessment. We'll cover this a little bit later in the presentation. So what do green bonds finance according to the Green Bond Principles, or the GBP? The GBP provide high-level categories for eligible green projects in recognition of the diversity of current views and the ongoing development in the understanding of environmental issues and consequences. The GBP explicitly recognize several broad categories of eligibility for green projects, as you can see on the slide here. They contribute to environmental objectives such as climate change mitigation, climate change adaptation, natural resource conservation, biodiversity conservation, and pollution prevention and control. The list you see here of project categories, while indicative, captures the most commonly used types of projects supported by or expected to be supported by the green bond market. In part 3, I'll cover some of the developments that we've seen in the green bond market and talk about issuance volumes, types of issuers, currencies, and some of the countries that have been the most active in the green bond market. You can see from the slide here, which shows cumulative issuance of green bonds in purple, along with annual issuance volumes in green, that the green bond market has seen rapid growth in recent years. From a total issuance of US dollars 39 billion in 2014, the market has seen issuance rise to $100 billion in 2016, reaching $185 billion by the end of 2018. With a further 20 billion of issuance so far year to date in 2019, this takes the cumulative green bond issuance volume to over $600 billion. However, as big as that number sounds, it's worth noting that there's still a very small part of the total bond market. Outstanding green bonds are estimated to account for approximately 1% of the total outstanding bond market. So as the green bond market has grown in size, the diversity of the types of issuers tapping the market has increased. The initial drivers of the green bond market were public entities such as supranationals, municipalities, and government agencies. These have since been joined by financial institutions, such as many of the leading international banks, who have issued green bonds to finance their green loan business. Large corporations such as Apple have also entered the market in order to invest in energy projects, to improve energy efficiency of their facilities, and reduce emissions in the supply chain. We've also seen the emergence of sovereign green bond issuance. This is where countries issue debt through their national debt management offices, specifically for the financing of environmental projects and initiatives. In terms of geographic distribution, the countries represented in the green bond market have also been increasing. Whereas the USA and European countries dominated in the early years of the market, many developing countries have become more prominent, with China becoming the second largest country of issuance in the space of the last 3 years. Sovereign and corporate issuance from countries such as Indonesia, Mexico, Brazil, and Nigeria have also added considerable volume to the market in recent years. With respect to currency of issuance, euros and dollars dominate, but currencies such as renminbi in particular, as well as Swedish krona and Australian dollar, have also increased. One final point of note is respect to the pricing of green bonds. As demand for green bonds has increased, the pricing dynamics have changed to the benefit of issuers of green debt. While in the most part, investors are not willing to pay a premium for green bonds in the primary market, there is an improved performance of green bonds in the secondary market compared to conventional debt or non-green bonds. For repeat issuance of green bonds, this is being translated into cost savings when they return to the market. So this next section addresses the question of why you would want to issue a green bond and why investors want to buy them. So implementing sustainable finance into the financial system is a process that draws on several interdependent practices, but there are of course a vast number of specific initiatives, some of which are mentioned in the slide you see in front of you. A number of investment principles or guidelines have been developed. The United Nations supported Principles for Responsible Investment, or PRI, consists of 6 voluntary principles that have been adopted by over 1,800 investors who collectively have assets under management in excess of $90 trillion US. Most investment mandates have negative screening techniques, but the PRI have also introduced the concept of positive screening, focusing on what investors want to invest in, for example, by setting social or green investment targets. Sustainable products create investment channels for investors who would like to engage in sustainability-related investment opportunities and to be able to communicate the impact of these investments. In addition to green and social bonds, other products are emerging. Most noticeably, there are green funds that have been established by large asset managers such as BlackRock, Amundi, Nikko, Mirova, Storebrand, and SEB, as well as green listings at numerous stock exchanges around the world, such as Oslo, Stockholm, London, to name but a few. New policies and improved reporting will be important to ensure that investors and their clients are informed of the environmental impact of their investments. These include the European Commission's Technical Expert Group on Sustainable Finance, which aims to develop a unified classification system for sustainable economic activities, a European Union Green Bond Standard, methodologies for low carbon indices, and metrics for climate-related disclosure. So what are green bonds contributing to the market? Investors who evaluate and invest in green bonds achieve intelligence on climate-related issues, which enhances risk management capabilities, obtains diversification through a green asset class, contributes to a reduction in climate stress, and are able to stay ahead of the technology transition by quickly adapting to changing regulations. In addition, green bonds offer an infrastructure that enables investors to live by their stated values and enhances competitiveness in a market where sustainability will increase its role in the years to come. Here's a quote from Frédéric Samama, Assistant Director of Amundi, the large French asset manager. He's identified the necessity of sustainable investment with the following quote: "Markets are short-term, so they're pricing the likelihood of polluting companies being penalized at almost zero. People are beginning to ask if they can really make that bet. If you misprice it, then you failed your fiduciary responsibility." For issuers of green bonds, you improve your diversification and flexibility of funding and deepen a dialogue with your investors. However, the most important effect from issuing a green bond, it establishes a targeted dialogue between internal functions such as finance, sustainability, environment, and project management, and improves competitiveness by strengthening the focus on climate and environmentally related issues and implementation of sustainability targets. Here's a quote from Drew Wolf, the Vice President of Treasury at Starbucks. And he highlights the importance of sustainability to Starbucks with the following quote: "We've partnered on other sustainability projects in the past, but integrating our corporate sustainability strategy with a core part of our capital structure has raised our level of integration and cooperation." Oh, God. Sorry, slight technical hitch. So for society as a whole, green bonds provide an arena for financial and environmental experts within companies, institutions, and organizations to mutually gain enhanced understanding and competence around the intersection of climate, environmental, and financial risks. In general, green bonds can be one important instrument which increases the climate risk awareness needed across industries in order to support the transition to a low carbon society. It helps mobilize human capital and facilitates the shift in financial and real capital towards a resource allocation aligned with avoiding a 1.5-degree scenario. Okay, section 5. This section we're going to go into a little bit more detail on the 5 pillars of a green bond framework. As I mentioned earlier, this framework is an integral document for any issuer who's contemplating issuing a green bond. The first of the green bond principles is use of proceeds and the definition of eligible projects. In other words, what type of projects the money from the bond can be used for. The issuer decides what their definition of green is, so that investors can decide whether they also agree with this definition. The second principle is process for project evaluation and selection. This concerns the development of a process for project selection. In other words, how you make sure that the projects you select are indeed in line with your definition of green. The third principle is management of proceeds. This concerns traceability and monitoring of funds raised for sustainable finance. In other words, the procedure the issuer sets up to make sure the money raised in the bond is not mixed up with money from other sources, and that there is a way to easily track the money from when it is sourced in the bond market to when it is invested. The fourth principle is around reporting, as it's essential to be transparent with investors and the market by letting them know what type of projects receive funding through the green bond and what type of environmental benefits are contributed to. In addition to these 4 principles, external reviews through an independent external assessment is as of now considered a recommendation. It is not presented as one of the principles, but many investors appreciate and often require an assessment made by an independent party with environmental competence. The 4 green bond principles are used as a guideline when creating the green bond framework, as we'll see with an example from Volvo Finance. As per the green bond principles, the green bond framework consists of a list of eligible projects, as a process for selection of eligible projects, a special account description described as an earmarked account in the Volvo Finance green bond framework, and transparency through reporting. In Volvo Finance's green bond framework, the eligible projects are defined as a selected pool of loans and leases to vehicles that are funded in whole or in part by Volvo Finance Bank, and that promote the transition to low carbon and climate resilient growth as determined by Volvo Finance Bank. In other words, the projects or assets of a bank are so-called green loans. Below this, you can see a list of the cars that are eligible for these loans and leases. As per the green bond principles, Volvo Finance green bond framework also outlines their selection process, whereby the head of Treasury and the head of sustainability must reach a consensus. There is also a process for earmarked accounts and a plan for impact reporting. This example shows one issuer's approach when developing its green bond framework. Since different issuers work in different realities, the green bond frameworks should be tailor-made to reflect their different ambitions and their capabilities. Now I'm going to pass it back to Harald, who's going to take over the next section on the external review.
Thank you very much, Ben. And now that Ben has convinced you to issue a green bond, and he also told you that on the financial side, a green bond is just a normal bond. The key question is, of course, what is green? And that's where the external review play an essential role. So the key question is, who defines green and what is green? Is it green to do energy efficiency in a refinery? Or is it green to invest in a green building that is part of an airport? Ben has already showed you the green bond principles that all the major stakeholders has signed up to. But in this market, they are voluntary principles. There is no one authority that decides what is green in the green bond market. But we have some country level guidelines in some markets. And the most advanced when it comes to the regulatory level, it's the Chinese regulation. They have developed their own taxonomy. There are work going on also in the EU to work on taxonomies to help the market in order to scale up. This is because the green bond principles are not very specific on defining what is green in the market. But in addition, in the green bond principles, they require to have external review, or they encourage you to have an external review. That's the same as the stock exchanges. In order to be listed on Luxembourg Stock Exchange, London Stock Exchange, other stock exchanges, you need to have an external review. In addition, you have green bond indices and funds, and they have criteria for inclusion, meaning that they take indirectly a decision on what is green in the market. The green bond market is about enhanced transparency and opening up a communication channel between issuers and investors. We see our role as external review providers to facilitate this communication. Last year, ICMA introduced guidelines for green bond external reviews at the international level, and here you see the key elements for external reviews. You should focus on integrity is important, objectivity, professional competence, and care. Also confidentiality and professional behavior. This guidance to external reviewers we very much welcome, and we see it as a positive development, as well as country level programs to provide guidance and support for external reviews of green bonds. External reviews play a part both pre-issuance and after the bond has been issued. Here you see an overview of the range of approaches to pre-issuance review. Framework consulting is separate from external reviews. There was a market practice where framework consultants also providing external reviews. However, the new ICMA guidelines go some way to discourage this, and there is an increasing awareness of this in the market. Among external reviews, the most common types are second opinions, green scorings, and certification against standards. Second opinion are the most common form of external review, and we will focus on these for the rest of the webinar. There are a range of different providers and approaches, and the vast majority of providers review alignment with the Green Bond Principles. Some go further on evaluating environmental criteria and governance. The rating agencies have also recently entered this space with their own green bond rating and scorings. Again, there is a range of methodologies. The third form of external review is certification against standard. The most common standard used is the Climate Bonds Initiatives standard, CBI. Before we dive into second opinions, give an example of that process. Here is an overview of the types of external review post-issuance. We see an increasing trend for issuers to complement the pre-issuance external review with a review of their use of proceeds or impact reporting. I will be going over impact reporting in more detail later. It is also possible to update rating or second opinions based on updates to the framework. Moving on to second opinions. As an example, here is our second opinion process. Second opinions are desk reviews, and the Green Bond Framework is the key document. Other relevant documents include corporate strategies and policies, and project-related documentation. If an issuer with a framework that includes green buildings, you might want to send any green building certification, energy usage, and energy efficiency targets, and your policies on sustainable procurement of materials. The gears represent the key drivers of our analysis. The Green Bond Principles is the starting point, but they do not go far enough in defining green. This is the link to climate science, which we supplement with any relevant standards. For example, green building rating systems like LEED. For every opinion, we point our strengths, weaknesses, and pitfalls, providing transparency to investors and feedback to issuers. Our process includes a step with questions and clarification with the issuer before finalizing the opinion and assigning a shade of green. The shade of green is our green rating on climate risk. We think it's key to take a non-binary view on green. To categorize investments as risky or safe would sound too simplistic to most in the financial sector. Climate risk is the same. There are different gradients or shades of green. Climate science tells us in a 2050 perspective, we need near zero carbon climate resilient solutions. In our rating, these are the dark green solutions. However, there is also a need for bridging technologies and shorter term solutions. These are medium and light green technologies. When considering light green project, we need to be careful to avoid lock-in of emissions. For example, new fossil fuel infrastructure could not qualify. Efficiency in fossil fuel that decreases cumulative emissions would. Light green projects are crucial to a successful green transition. So we see here that the dark green solution will, for example, be renewable energy, such as solar and wind, while the light green is more energy efficiency in fossil fuel infrastructure. Since we introduced the shades of green in 2015, We have shaded more than 76 frameworks. Here you see the overview of those 76. By project categories, we can see more clear trends. Renewable energy is often, as I said, dark green. Efficiency buildings are more medium green. Some reflections on the light green categories. Fannie Mae, for example, the largest issuer in the market, was awarded light green. And in our view, as we said, we really need to move towards the dark green solutions. But in the shorter term and the medium term, we also need the light green projects for a successful green transition. And it seems like many investors agree. So also the light green projects or the light green bonds are oversubscribed. Green bonds open a communication channel between issuers and investors. The most important communication tool are the framework and the external review report, pre-issuance and impact report post-issuance. Green bond investors expect reporting from green bonds and expect to be informed on the environmental impact of their investments. This transparency is key to the integrity of the market. However, two important qualifications. Market is aware that there is trade-off and no one wants to set the bar so high that it discourages new entrants. Different expectation to a large corporation with a sustainability department and a small issuer financing one solar project. Standards for impact reporting are still evolving. No one right way to report environmental impacts. It is also key is it to be transparent on methodologies, assumption, and to be consistent. If you're using one set of emissions factors for corporate greenhouse gas reporting, advisable to use the same for green bond reporting or be clear on reasoning. Impact metrics provide investors with quantitative measurements of direct environmental or social impact from investments. Carbon emissions are often cited as a key metric. And while emission savings can provide important information, we also encourage issuers to report on green metrics. By this, we mean the measures that show the project's positive contribution to the low carbon transition. An often cited example, which is easy to measure, is the installed capacity of electricity by a renewable energy source. Also, to measure the electricity produced is another metric. For some projects, it may prove difficult to find exact and quantitative measurements, such as biodiversity conservation or climate change adaptation projects. In those cases, a qualitative description may be more suitable. As always, transparency should be the guiding principle when doing impact reporting. As mentioned, impact reporting is an area of innovation and standards and guidelines are under development. The ICMA Working Group on Impact Reporting have published 3 sector guidelines so far: water and wastewater management, waste management and resource efficiency projects, and clean transportation. And they're also just now finalizing the metrics on green buildings. Also, additional guidelines from MDBs and Nordic public sector issuers published a joint position paper on impact reporting, useful also outside the Nordic context. And these Nordic public sector issuers guidelines were just updated. To sum up some key points, green bonds open a communication channel to investors. External reviews help facilitate this communication. Creating a common language for investors, scientists, and companies is key. All shades of green are necessary for the transition. The key is to avoid locking in obsolete infrastructure. Investors expect impact reporting from green bonds. It is key to be transparent on methodologies and assumptions.
All right. Thank you, Harald and Ben, for your valuable insights on green bonds. So before I provide you with some final information on additional resources and contacts, if you have any questions already, feel free to type them into the chat function in GoToWebinar. So if you want to get more information on the key concepts and initiatives covered in this webinar, here's a list of references for your consideration. If you want to learn in more depth about the topics covered, you can also view our online learning program consisting of 3 videos. You can access those via our project website and Cicero's YouTube channel. The links to the online learning series, as well as to the recording of this webinar, will be made available following this webinar. You can find our contact details in this slide if you have any further questions. Feel free to shoot us an email. So, without further ado, we are ready for your questions. If you have any, please submit them in the chat function and I will pass them on to Ben or Harald, depending on your question. So as of now, we don't have any questions submitted. Oh, there is. 1 second, please. All right, I can see the questions now. And the first question posted by Hani is, are green bonds available for investment by private investors, individuals, and not corporate? And if yes, how to go about it?
So I can take a stab at that one. I mean, green bonds are bought by a large variety of investors, but that includes asset managers who are buying on behalf of funds, that they manage, and that's then available through their channels to retail investors. So there's certainly availability to retail investors, but through through the products that kind of asset managers and banks offer to retail investors, usually in the form of funds. So that's how we've experienced kind of retail interaction with green bonds. In some countries, there's very much kind of retail programs. In Japan, for example, the retail bond market is extremely strong, and a large amount of volume is raised in that market. And so that's it varies a little bit from country to country, but I would say that most of the large asset managers who then have funds available for retail are already active in the green bond market.
Thank you for that, Ben. Another question posted by Raphael. Oh, I've lost it now. Could you please talk about how to assess the default risk of green bonds? Ben, Harald?
I mean, as I mentioned right at the beginning about the essentially the bond, a bond versus a green bond. I mean, the credit dynamics, if you like, are exactly the same. So there's no with the credit risk that you have with a bond versus a green bond are exactly the same. So you're facing the same credit. When you buy a green bond, the credit dynamics, the credit rating of the bond issuer, if they're issuing a regular bond or a green bond, are exactly the same. So that was very much, or that was very important when we established the green bond market, was that the risk that you face as an investor is the same. It's just the use of proceeds that are different. So it's very clear that there's no differentiation in terms of the credit of the bond issuer if they're issuing a bond that is green or non-green.
And similarly, there's a question about the returns. Is it the same way for the returns? Yeah,
very much so. I mean, because the dynamics, the bond, the credit rating, if you like, are exactly the same, because the risk is that of the issuer rather than the underlying project for the most part. What we're seeing in terms of pricing, i.e. returns, is that there's the demand for green bonds is outweighing the supply of green bonds in many markets, and that's leading to pricing performance, which I mentioned a little bit earlier. So you're seeing a improved performance in the secondary market for green bonds as a function of increased demand, but the pricing is still very, very similar, and the yield, like I say, is very similar.
I can just add to that I've been, because the whole exercise from our side is to provide transparency on the green and the climate risk. And I think I've been in, this is not kind of science-based, but I've been in panels where investors have said that they might be willing to pay for more transparency. And that's what this exercise is about. It's about providing transparency on the climate risk. And as I underlined, we see climate risk as a financial risk. So through this process, you actually, investors, get more information about this. But I completely agree with Ben that the pricing of the bond is linked to the financial ratings, and they are not yet fully incorporating the climate risk information.
Okay, thank you, Harald. So maybe another question for you, Harald, from Zasha. He says, could you provide some good examples where green bonds have been used for adaptation projects?
Yes, I would love to see many more on the resiliency part. But I think one good example is the Dutch Bank. That was one that focused mainly on resiliency. So that's a very good example. And you also have where they look at a lot of different measures to avoid sea level rise, etc. But also many of the multilateral development banks have project categories where they cover resiliency and adaptation. But I think from our side as well, it's a real integration between mitigation projects and adaptation projects. So for us to qualify to be a green building, you should not only look at the energy efficiency of the building, but you should also, for example, screen for flood risk, etc. So it's not about mitigation on one side and adaptation on another side. These are integrated projects.
One thing I can add from the multilateral development banks, the supranationals, they were very early in terms of including adaptation as an underlying project or asset for their green bond frameworks. So I would recommend just taking a look at the green bond frameworks of the World Bank, IFC, Asian Development Bank, African Development Bank, because there you'll get a picture of what type of projects that they would include under adaptation.
Okay, thank you for that. I have another question for you. Does any of the principal standards contain standards for the consultation and consent of local communities? I suppose they mean the local communities of where the project is being implemented.
I can try to answer that. The green bond principles are not very detailed on that, but when we look into and apply our methodology, we, for example, when we look at, I showed you the dark green project categories, which includes renewable energy, but of course we are all aware that, for example, hydro plants could be controversial projects. And in order to get the dark green shading in our methodology, you need to have safeguards in place, and that includes having a transparent process and engaging with local communities. So very often in this green bond market, we see that there are references to the IFC standards, etc., where you need to have kind of due processes in place. And also for us, it's important when we look into it, the local regulations. So these are something that we definitely look into, but it's not kind of detailed in the green bond principles. And that's why it's so important to have an external review.
Okay, thank you. So there's another question about the recording of the webinar. And just we will be providing a recording for those who joined later. But I have some more questions for you. And one asking, how much time does an external review take? Like how many days of work does it take for the full external review on your side?
The process time-wise, we say a standard process is 3 to 5 weeks. So before you kind of come to us, you need to have the framework in place. And when you have sent us the the necessary documentation. After maximum 2 weeks, you will receive a draft second opinion with questions. Then we would like to get written feedback on our questions, and we set up a phone call, often a week after. So that means we have spent 3 weeks, and then when we have got all our input, we need 1 week to finalize the second opinion. So 4 weeks, we could do it quicker if we get the response from the issuer very quickly, but normally it takes 3 to 5 weeks.
Okay, thank you for that. So another question about regulation. Do regulators provide additional incentives or tweak regulations for issuing green bonds more easily?
We've seen some regional initiatives, less on the asset side in terms of risk weighting for green assets. We haven't seen anything like that yet, but we do see some jurisdictions offering some kind of support with respect to the external review and covering the cost of an external review, for example. So that's what we've seen in some markets. But in terms of kind of regulation that's supporting or giving some kind of alleviation of capital requirements for green assets, that is being tabled at the European Union level, but nothing as yet is in place.
I can just add to that, but I think kind of that's one of the key drivers of this market as well, that it's opening a communication channel between the issuers that have green projects. So they really want to engage with the investors that are longer term thinking. So it is a voluntary market. So the trend here has not been driven by kind of subsidies. So that's a very interesting market to that extent. And as Ben underlined, kind of what we know for sure is that you reach out to new investors. That could be very important if you run into financial problems and you need to renegotiate the financial terms.
Okay. And then another question from the investor perspective. What is more important for the investor, the success of the green project or the creditworthiness of the issuer?
I would say it's a bit of both. I don't think it's one or the other. I mean, really, as an investor, you're kind of, your investment decision and the way you're reaching a decision with respect to investing in the bond is are you getting paid enough for the risk associated with the credit that you're buying. So you would really hope that the credit performs as per your analysis and your expectations. But I think the one thing that Harald mentioned with respect to the green element and therefore the project side of that question is, it's clearly going to be beneficial to you if you're getting that information, that additional information that you wouldn't get otherwise from a conventional bond, and also that you are getting the type of information with respect to the environmental benefit that you wouldn't get otherwise as well. So if the project is really performing as per what the issuer has promised initially, then clearly you're going to be able to demonstrate, one, I'm getting return as per my analysis of the credit and what my expectations were there, but also that I'm creating much more or the expected environmental impact that the issuer said they were going to do when I invested. So that's a kind of a double win in a way. So I think it's not one or the other, it's both. You really want both.
And then again, I think there's a difference between, it's not only one investor. They have different mandates and it's different focus, but I think all of them focus on the financial risk, of course. But to what extent they focus on the impacts depends a little bit on the investor. So for some investors, they focus very much, they want to make a difference. So they really, for them, they will not invest in a green bond if there is not thorough impact reporting. But for other investors, that might not be that important. But if you want to go to the market with a very solid and reach out to the right investors, it's about the financial risk, but it's also about showing that it makes sense and that it's kind of have impact.
Yeah, and that's what we hear from investors, much more use of this terminology of a dual fiduciary responsibility. I have fiduciary responsibility to make sure that I'm creating the most return for my investors, for my shareholders and my stakeholders, but also that I have another fiduciary duty, which is to create as much impact as possible at the same time.
Okay, Thanks so much, Harold and Ben, for answering all these questions. And thanks to all the participants who have posted questions. We hope that you enjoyed this webinar and you could learn and take something away from it. We will make the recording available on our website later on. And we wish you all a great remaining day and see you next time. Bye-bye.
Okay.